Good morning and afternoon, everyone. Welcome to the second webinar in our fourth annual quarterly perspective on tax law series. My name is Justine Benoit. I'm a partner in Fasken's tax group, and I'm also located in Montreal. My practice is mainly dedicated to structuring transaction, investments, mergers and acquisition, and corporate reorganization. Before I introduce my fellow tax partners, please see the information outlined on the screen. I'd like to draw your attention to the survey and CPD certificate points. QR codes and links will be available at the end of the event to fill in our survey and to obtain your Ontario, Quebec, or BC CPD certificate. We'd appreciate it if you could take a minute to fill out our survey as well. So joining me today is Laurie Bokenfohr, a partner in our Calgary office. Laurie advises both domestic and international clients on a broad range of tax matters. She has a strong background in corporate and reorganizations, business succession planning, executive and employee compensation, immigration, trusts, and estates. Rahul Sharma is a partner in our Toronto office. He advises international and Canadian clients on tax, trust, and estate planning matters. He is experienced with cross-border and international trust and estate, as well as matters involving offshore trust with ties to Canada. He also counsels high and ultra-high net worth individuals on Canadian income tax matters, including succession planning for closely held businesses. He advises both Canadian and non-Canadian trustees and trust companies on Canadian tax matters. Now on to our presentation. On the first slide today, we will be covering cross-border investments, trust, resident and non-resident, and departure from Canada for tax purposes. I'll be kicking things off today by walking you through the first section, cross-border investment. But before we dive in, I just want to emphasize that there's no one-size-fits-all solution. The optimal strategy depends on the range of factors: your residency, the type of income earned, jurisdictions involved, how the investment is financed, and your long-term goals. And as many of you know, that what's true today in tax may be sort of outdated tomorrow. A good example is the One Big Beautiful Bill Act. You've probably read about it. So this U.S. bill could result in additional taxes on U.S. investment held by Canadians. But I mean, we don't know all the details. Details are still uncertain. And the bill is currently under Senate consideration. But, you should keep that in mind, that tax law is evolving and fast. So I invite you to approach today's session about cross-border investment as more of a checklist of key consideration. So, key concepts. Let's begin by sort of grounding ourselves in key concept. First, tax residency. It's fundamental. It determines where a person or an entity is taxed on its worldwide income. My partner, Laurie, will go into more detail on this later. Next is double taxation, and it's more nuanced than it might seem. While it often refers to the same income being taxed in two jurisdictions, it can also arise from mismatches on how countries apply their tax rules. So for example, one country may tax a gain on a property while the other taxes the value of that property. Or one country may treat an entity as a corporation, the other may treat it as a partnership. There are also domestic double taxation in cross-border contexts. A good example is a non-resident investing in Quebec real estate. Quebec, the province of Quebec, imposes its own tax on rental income and capital gains from real estate, and the federal government does not provide a corresponding reduction in tax. This creates an extra layer of tax for non-residents investing in Quebec, of course, if nothing is done. Canada addresses some of these issues through foreign tax credit and tax treaties, but they don't always fully resolve the problem. Then we have foreign accrual property, FAPI rules. These apply when a foreign affiliate, like a corporation, foreign corporation owned by a Canadian taxpayer earns passive income, such as interest, dividends, or rent. FAPI prevents deferral by requiring that this income be included in the Canadian taxpayer current tax return. Many countries have mirror rules. It used to be possible to mitigate the impact of FAPI through planning, but the 2022 federal budget tightened those rules, and now the deferral opportunities they don't exist anymore. Withholding taxes are another key concept. These are taxes withheld at source on cross-border payments like dividend, interest, and rents. Tax treaties often reduce these rates, but these still need to be planned for. Sometimes they represent a final tax in the source country, but not always. In some cases, non-residents can elect to be taxed on a net basis if they were residents of the source country. This is common with rental income, for example, where a non-resident can choose to be taxed on net rental income instead of facing withholding tax on the gross amount. So you may be aware of those rules. And finally, foreign tax credits. They help avoid double taxation by allowing taxpayer to claim a credit for taxes paid abroad. In Canada, the credit is generally limited to the amount of Canadian tax otherwise payable on that foreign income. So, quick example, if you're a Canadian resident earning foreign dividend income, you have to include your dividend sourced from another country in your Canadian income, and you can claim foreign tax credit for the foreign tax paid, including the withholding tax. So with these concepts in mind, let's move on to our checklist. Before we dive into some strategies, it's important to understand sort of the basic framework of how cross-border income may be taxed. You can think of it as a three-layer cake. Each layer represents a different point where tax can be imposed. This is a simplified example for you to understand. Starting from the top, layer one, taxation at source. Next slide. The first layer is where the income is earned, or the gain is earned. Let's call it country A. If you earn rental income, dividends, or business profit in country A, that country typically asserts the right to tax that income first. Layer two, withholding tax on repatriation. If you want to bring that income back to your home country, country B may impose a withholding tax on the cross-border payment. And the rate depends on the type of income and whether a tax treaty applies. Layer three, taxation in country B, so the taxpayer's residence. Once the income is received or deemed to be received or earned in country B, it's taxed again under that country's domestic rules. So in a typical cross-border investment planning, income can be taxed when it's earned in the foreign country, when it's repatriated, and when it has to be reported by the resident taxpayer. That said, not all three layers always apply. So for example, if passive income is earned and taxed in country A, and then reported in country B under the FAPI rules, for example, but not repatriated, the withholding tax, the layer two, may not apply yet. Or depending on the structure, income from country A may only be subject to withholding tax layer two and taxed in country B layer three. And it's also possible that there's no tax in country B on foreign source income. Therefore, only layer two can apply in certain circumstances. So the goal of deferral planning is to delay taxation at one or more of these layers. It's just about time value of money. So in some situation, even if the effective tax rate, like on a fully distributed basis on all the layers, is not great, deferring tax for several years can still improve your after-tax return. The goal with exit planning, so when the investment is sold, is usually simply to minimize the tax. And this often is just being implemented by minimizing the layers of tax applicable at exit. So for outbound investments, for Canadian taxpayer investing abroad, one common deferral tool is the use of foreign affiliates, so foreign corporations. So if the income earned is active business income, it can generally be deferred from Canadian tax until it's repatriated. But if it's passive income, like we've seen, it's caught by FAPI and taxed in Canada immediately, even if it's not distributed. So the structure and the nature of income are critical. On the exit side, since capital gains have a favorable tax treatment in Canada for Canadian taxpayer, as a general rule, I would say it's advisable to try to have Canadian taxpayer realize the gain in Canada directly or through a flow-through entity like a partnership. For inbound investments, the same deferral principles apply. Deferral may be possible or advisable if the Canadian tax rate is favorable compared to the investor's tax rates, which is not always the case, or if withholding tax on repatriation can be deferred or minimized. At the exit, so when a Canadian investment is sold by a non-resident investor, Canada may retain the right to tax the gain if the investment is taxable Canadian property. Laurie will talk about the concept of taxable Canadian property later on. Taxable Canadian property, for purposes of our slides, let's say includes real estate. So if the investment is not taxable Canadian property, so non-real estate, the non-resident investor is technically not subject to Canadian tax upon the sale. So it is possible to structure the exit from Canada, so of a Canadian investment in the example country A, in a way that only country B would apply the tax. And so you would not have the first two layers of tax. Now, I just want to mention briefly the Canadian integration principle, which is a principle that is part of Canada's domestic tax framework and applies to Canadian resident taxpayer. The principle ensures that income is taxed similarly, whether it's earned personally or through a Canadian corporation. For passive income, this generally results in tax neutrality. So there's a small advantage, but there's no real advantage to using a corporation. But for active business income, earning it through a corporation in Canada can result in a real tax deferral because the corporate tax is lower and the personal tax is only triggered when the dividend is paid. So you should keep that in mind when structuring cross-border investment as well. Finally, because all of this comes down to after-tax returns, it's essential to try to model different scenarios to understand the short-term and the long-term impact of your structure. So while there's no one-size-fits-all solution, understanding where tax deferral is possible and that you can plan your exit in a tax-efficient manner can help you and your professional build a tax-efficient cross-border structure. So now let's turn to how we can make use of tax treaties. Before we start, just a quick note on treaty shopping. That's not what I'm talking about here. So artificial arrangements designed solely to access treaty benefits without real economic substance can be challenged by tax authorities under anti-avoidance rules and limitation on benefits provisions. So today, what I'm talking about is simply use of a tax treaty when you're allowed to, and not treaty shopping. So tax treaties are designed that their goal is to prevent double taxation and resolve disputes between countries. So for investors, they create a more predictable environment, and they clarify how income will be taxed and by who. Dividends and interest, for example, may be taxed in both countries, but treaties set limits on how much the source country can charge. In Canada, the default withholding tax rate is 25%, but under a treaty that can drop to 5%, depending on the relationship between the payer and the recipient. For example, a Canadian subsidiary paying a dividend to a Hong Kong parent company may qualify for a 5% withholding tax rate instead of 15% for a Hong Kong individual, shareholder of a Canadian corporation. And of course, if the ownership threshold is met, but it's to show you how you can use treaties without being necessarily aggressive. But finally, to benefit from the treaty, you need to qualify. So it means ensuring that the entity or the individual meets the residency requirements, is the beneficial owner of the income, and complies with limitation on benefits provision or anti-avoidance provisions. So tax treaty can be tools that you can use to reduce your tax costs in cross-border investment. Next, choosing the right legal structure. This is a quick overview of the most common categories of legal entities we encounter in a Canadian cross-border context. The goal here is just to highlight their key features. So for corporations, they offer limited liability, and for active business income, like we said, there's a potential for a tax default. However, a common pitfall we continue to see is the use of US LLCs, which are corporations, by Canadian taxpayers. One of the reasons why it doesn't work well is that LLCs are treated as flow-through entities in the US, and Canada treats them as corporation. So this mismatch can lead to double taxation, so you should always consult with your tax advisors when dealing with LLCs to make sure that there's no negative tax consequences. Partnerships. A partnership is not a taxpayer and does not pay income tax. It's a flow-through entity. The income earned by the partnership is allocated to its partners, who are taxed individually. Partnerships are often a tax-efficient structure for, or used to be, or we don't know, but for holding passive US investments. So for example, US rental income held through a properly structured partnership, not necessarily US LLP or LLLP, we need to be careful about that, can achieve a favorable effective tax rate on a fully distributed basis. The same applies to capital gains. However, partnerships don't offer tax deferral, so you need to be aware of that. There's no tax deferral. And selling a partnership interest to a non-resident of Canada or tax-exempt entity can trigger unexpected gains in Canada, so you also need to be cautious about that. Trusts are great entities for estate planning and asset protection. They're often used to defer debt or estate taxes. That said, they must be structured carefully to avoid any adverse tax consequences. For example, we have in Canada attribution rules, which may cause income and gains earned by the trust to be taxed and allocated in the hands of the settlor or a person who contributed to the trust. So trusts really have to be properly set up. In many cases, the optimal solution is a hybrid structure, a mix of different entities. So for example, one entity provided creditor proofing would be put in place with another entity for some tax deferral. Ultimately, the right structure balances tax efficiency, legal protection, long-term estate plan. And as always, I mean, you should, if you can, model the after-tax outcomes of your structure. Next slide. Let's now turn to tax-efficient financing. So if leverage is introduced, the investor should assess if they want to borrow in Canada, in the foreign jurisdiction, or introduce cross-border debt. The key here is really interest deductions and expense. Interest payments are generally deductible, reducing taxable income in the borrowing jurisdiction. This can be useful when the borrower is in a high tax country, or if other entities of the group do not have interest deductibility capacity. So from a Canadian tax perspective, we have specific rules which set limits to the amount of interest the taxpayer can deduct in Canada. So you need to be aware of that, but we're not going to go into details in those rules. Another point to consider is the transfer pricing rules. They apply to loans between entities of the same group residing in different jurisdiction. The cross-border interest rate charged between those entities must be at arm's length, meaning it should reflect what an independent lender would have charged under similar terms. If the rate is too high or too low, the tax authorities can adjust it and potentially denying deductions, reassessing income. So you also need to comply with transfer pricing. And finally, and quickly, you should not overlook currency and withholding tax. Cross-border interest payments can be subject to withholding tax, and foreign exchange can create consequences, so you should take that into account. Next slide, estate planning. So let's close with a quick look at estate planning. The earlier you plan, the more options you have, period. So estate taxes, as you know, probably know, vary between countries. For example, Canada doesn't have an estate tax, but it does impose a deemed disposition at death on gains. By contrast, the US imposes estate tax, and for non-residents, like for Canadians, it would apply on the value of US situs assets, take into account a whole calculation. Other countries like France impose a inheritance tax. So, I would say that generally tax treaties tend not to cover those taxes very well. So there's a potential for double taxation and also great potential for good tax planning. I will finish by mentioning that for estate planning, coordination across jurisdiction is very important. So wills, powers of attorneys, and other legal documents should be reviewed in that context. So with that, I'll hand it over to my colleagues who will take a deeper dive into two related areas, trust and departure from Canada. Thank you.
Thanks, Justine. So I'm Rahul Sharma, based in Toronto, as Justine mentioned at the beginning. Going to speak about trusts, both resident and non-resident. Questions that we get quite often center around trusts in particular. And there are some conceptions, misconceptions. Hopefully we'll give you a good overview. And obviously, if there are any questions, you're welcome to raise them in the Q&A comment section. If we could go to the next slide. I just want to talk about, people ask quite often, okay, what's the benefit of a trust in the Cayman Islands versus a trust in Canada? What's the benefit of a trust in the Channel Islands? Or why would we go to a different place other than Canada to set up a trust? Well, forget the tax for a second and just think about basic trust law concepts. So trusts in many Canadian provinces are subject to perpetuity periods. So the trust can't last forever. It's subject to a perpetuity period where the trust will, once it reaches that perpetuity limit, have to come to an end. There's an Accumulations Act in Ontario, for example, where income within a trust generated can only be accumulated by the trust, meaning taken into the trust and added to capital for 21 years, for example. It depends what you want to do with a trust. That might not be to your liking. It depends on what kind of trust you're setting up, and it depends on whether there's a Canadian tax connection, which we'll talk about in a second. But many of these jurisdictions offer no or very low tax on income and gains. So that's there. But one of the key factors of certain jurisdictions like Jersey, Guernsey, Channel Islands, for example, is firewall protection. And firewall protection effectively protects the assets of that trust subject to certain considerations as to the time of settlement and other considerations that are unique to the circumstances in which the trust was established. But suffice it to say, if no one was really chasing the settlor or contributor of funds to the trust, there were no claims against that person, there were no judgments against that person, there was no creditors or creditor considerations, and there was a business sale, there's a bunch of cash generated, and this individual says, I want a rainy day fund, I want a protected fund, I want a fund which is more difficult to access, I want to protect these assets because I worked hard for this. That is a good opening for doing or planning with trusts in a foreign jurisdiction to access that kind of firewall or creditor protection. Another point, you get often fast, swift, reasonably predictive or predictable access to the courts in these sorts of jurisdictions as well. They're good courts. Most of the English common law jurisdictions have excellent court systems, judges who are very well versed in this area of law. And you get, as a result, some good predictability of result, but you can also access certain remedies that may not be available in Canada. For example, Hastings Pass or mistake relief in certain of these jurisdictions is a way that you can even cure potential defects that could have or actions or omissions that could have a Canadian tax implication. So there's buttons to be pushed, there's levers to be pulled, there's flexibility to be had in these jurisdictions that can make them attractive. But if we go to the next slide, I want to talk about the Canadian tax considerations now of these sorts of trusts. So imagine a trust that's in an offshore jurisdiction. It's a favorable jurisdiction for all or more of the reasons that I just explained in the last slide. And you're now asking, okay, what is my Canadian tax consequence for this trust? So I've broken it down into three very general categories. You have the factually resident trust. This rides on case law. Often you'll hear this called the common law resident trust. And again, it rides on case law. It rides on case law like fundee settlement, for example, that came out of the Supreme Court, wherein it was determined that if mind and management effective control of a trust is exercised from Canada, the corporate rule will apply to the trust, meaning that the trust will be deemed to be factually resident in Canada and factually resident in the Canadian jurisdiction from which the mind and management is being exercised. So I'm here in Ontario. There's a trust, say, in the Cayman Islands, but I'm effectively controlling that trust such that mind and management is here with me in Ontario. Then that trust will domesticate into Ontario or will be considered to be a factually Ontario resident trust, notwithstanding that it is governed by the laws of, say, the Cayman Islands. So that's one way of entering and being part of the Canadian tax system. Deemed resident, bit more complicated. That falls under Section 94 of the Income Tax Act, which are often, that section is often referred to as our non-resident trust rules. Those rules, and I'm going to talk about that in greater detail in a second, but effectively consider those rules to apply to deem the trust to be resident in Canada for certain purposes. So that also can drag an otherwise non-resident trust into the Canadian tax system and subject that trust to Canadian tax. And then you have the Holy Grail, the Granny Trust. And this is effectively, imagine Granny has a lot of money, is in a foreign jurisdiction, establishes a trust in that jurisdiction or in a favorable jurisdiction for the benefit of beneficiaries who are resident in Canada. This kind of a trust, which is funded entirely by a non-resident of this country, someone who ideally has never been resident or has been a long time non-resident of the country, this trust would, if properly managed and administered, fall into neither the factually resident category, neither the deemed resident category. What's the advantage of this trust? Income can be accumulated in a very tax favorable way in certain jurisdictions, and capital can be distributed from this trust tax-free to Canadian resident beneficiaries, hence why I call it sort of the Holy Grail, or really an excellent tax plan. So if we go to the next slide, I just want to give you a little bit more detail. I mentioned fundee settlement as sort of the seminal case from the Supreme Court on when an otherwise non-resident trust that is theoretically managed and administered and subject to the laws of a foreign country could nevertheless be domesticated into our Canadian tax system on a factually resident basis. So this trust would be subject to Canadian tax reporting just as if it was resident in, say, Ontario or Alberta or BC or the jurisdiction within Canada from which the mind and management is effectively being exercised. There's a lot of interprovincial case law in this area where, say, Quebec is saying, hold on a second, you have an Alberta trust, but we really think that its mind and management is in Quebec, so it should be taxed here. Similarly, Ontario, there's a trust out in Alberta. It's always Alberta, Laurie. It's always you guys that are causing the trouble here. But the reality with these cases is, whereas we have a more limited supply of decisions from courts on international structures as between a trust or a foundation, say, in a foreign jurisdiction, whether mind and management is being exercised from Canada or not, we have a greater body of case law and interprovincial decisions which we can draw from in determining whether we have an issue, a factual residency issue with a foreign trust. So that's factual residency. If we move on to the next slide, this is a little more complicated. Deemed tax residency. And I said earlier, it's by operation of the provisions of Section 94 of the Act. In order for this, I'm giving you a very, very 30,000 foot up overview of this. But in order for this to apply, there needs to either be a resident contributor or a resident beneficiary. A resident contributor is a person who has contributed property to a foreign trust and who is a resident of Canada, who after making a contribution becomes a resident of Canada. So that's one way of falling into the system, and you have to be careful. A resident beneficiary, on the other hand, is a compound concept. There's two requirements to have a resident beneficiary. You need to have a connected contributor, and you need to have a beneficiary resident in Canada. And that is a more complicated concept. You could have a whole session just dedicated to determining that and giving you practical examples on when that applies. But a connected contributor is, as the name suggests, someone who has a connection to Canada on a residency basis at some point and who made a contribution to a trust outside of Canada, which has a resident of Canada as a beneficiary at a time that disqualifies or that taints that trust for Canadian purposes, and that accordingly causes these rules to apply. The rules are complicated. There are provisions that deal with indirect contributions. So you could make a contribution into a company that's wholly owned by a trust or partially owned by a trust. If that results in effectively the value of the trust figuratively increasing, you could be stuck in this system. The provision of services could drag you into the deemed residency rules. So there's a bunch of hidden places. And I want to stress this more than anything else. It is not intuitive. And if you're particularly sitting in a foreign country and you're a trustee in a trust company and you're going about your business on a day-to-day, your daily business, and you have this trust, you may never realize or appreciate that this trust may have been subject to Canadian tax for the last decade or more. We deal with that every day. And the reality of the fact that this is non-intuitive underscores the real need for good Canadian tax advice if you have foreign trusts with a nexus into Canada. But then there's the granny trust. If you go to the next slide, this is a trust where the trustee will face no reporting obligations. Annual income, as I said, can be accumulated, and capital can be paid tax-free. Again, we have a tendency in Canada of wanting our funds here. But when it comes to inheritance planning for high and ultra high net worth families globally, the Granny Trust is a very important tool and a very trusted approach. And it should not be overlooked. It shouldn't be that you think, okay, there's 15 million or 20 million or whatever of inheritance coming into Canada or more, and just bring it into the hands of the beneficiary so it falls in the hands of that beneficiary resident in Canada into the Canadian tax system. Laurie's going to talk about that in a second, about extrication from the Canadian tax system, but breaking up is hard to do, right? What I'm trying to say here is if you plan through a granny trust structure, you can achieve certain tax results that are not otherwise available in terms of having distributions of capital into Canada. The tricky part of the Granny Trust, though, is ensuring that what you're distributing into Canada is capital. It has to be capital for our tax purposes. And we see issues with this arising all the time. And that, again, underscores the need for even the trustees of Granny Trusts, where there is a resident of Canada as a beneficiary. If not, I would consider this to be essential that such trustees get good Canadian tax advice and understand what is capital and how they distribute it, because mistakes can be made. The beneficiary has to report the receipt of capital. The form is T1142, and it's a very simple form. And the problem with the form is that it's so simple that you can easily mess it up. By receiving income, declaring it as capital, and being audited later on, to realize that, oh my God, it wasn't. And it wasn't because of the way that that trust was administered. So getting your ducks in a row is essential regardless of the planning you do and regardless of the type of strategies or the type of approach you employ. But done well, this is a great planning opportunity. If we go to the next slide, I just want to talk very briefly. We've talked about this and I've touched upon it. Inheritance planning, we're seeing a very, very diverse society today. And we have in the last few years received more people into the Canadian system than we have ever before. And the reality of questions that are now starting to arise is, how do I plan my inheritance from a foreign country? The nature of the planned inheritance means it's not your money to begin with. It's not your property. You will, on the death of a relative, a parent, an uncle, an aunt, a grandparent, whatever the case may be, you may stand to inherit that money. So how should I get that money? What is the tax optimal strategy for me to receive that inheritance from the rich uncle abroad? And this is where planning is important. This is where the beneficiary should be making having these considerations, but should also have this should also be a family discussion as to how to plan in the best way possible. We're still seeing far too many outright transfers of significant amounts of money into the Canadian tax system from abroad, where that could have been better structured. So I just underscore that again. It's a point to take home from this presentation. And if we move to the next slide, I don't want to dwell on this too much, but every now and then we get calls where a beneficiary caller, or someone who is originally from France, for example, or from Belgium, has moved here, and they belong to a business family back home in their original jurisdiction, and there's usufructs that have been established for their benefit in that jurisdiction. And Justine is kind of nodding because, being a Quebec-based lawyer, she knows exactly what a usufruct is. But the problem is, in common law Canada, we're not used to seeing those civil law structures, and even in Quebec, not so much. The Income Tax Act has provisions that deal with how to deal with a Quebec usufruct, for example. Very foreign concept to common law audiences. But that same provision, and the CRA has stated this, does not apply to foreign usufruct structures in places like France or Belgium. And now you have someone in common law Canada looking at that going, how do I do this? How do I plan my estate? But how should my parents have planned the estate? How do we take care of the reporting for this? And how do we ensure that we're doing the right thing? Similarly, we're starting to see an increasing number of beneficiaries in Canada of foreign foundation structures. And where I mean foundation, I'm not talking in the Canadian context about charitable foundation structures. I mean private family foundation structures in jurisdictions where there'd be civil law. And even now in the Cayman Islands and Jersey, you can still have foundation structures that sort of are based on those common or civil law models. Is it a trust? Is it not a trust? Is it a corporation? Is it not a corporation? A lot will depend on the circumstances of planning. Suffice it to say that this is complicated, and you need proper advice to look at this. But you need to also be aware that where a structure where it potentially exists, the Revenue Authority here in Canada is likely to want to domesticate it into our tax system by having it fall within a category of entity recognized by our Income Tax Act. And that's where you may have a tussle with the Revenue Authority saying, I don't agree with you or whatnot. But the reality of the matter is this has to be planned. And Justine mentioned FAPI. FAPI could be a consideration if this structure is effectively controlled from Canada. I have seen examples where you have foreign foundation structures where services are being provided by Canadian residents in a way that would otherwise cause the provisions of Section 94, the deemed resident trust rules, to apply. So just because something is outside the country and it doesn't look like something that we would necessarily have within our country or within our legal or tax system, doesn't mean that there isn't some form of a potential Canadian compliance obligation, or that CRA will not be interested. Again, there's ways to structure this properly, efficiently, nicely. And if I leave you with any thought if I leave you with only one thought to take home with you today, it's that at the end of the day, please get good advice when it comes to foreign structuring, because the lack of good advice in this area, or thought out advice, can have repercussions in Canada. Whereas if you had just calibrated it in one way, you could have set something up in a much, much more tax-friendly manner. So with that, I pass it on to Lori.
Thanks, Rahul. So I am going to talk about departure from Canada for tax purposes, or as Rahul put it, extrication from the Canadian tax net. And there can be business or personal reasons why an individual may want to leave Canada. But at a high level, I am going to talk about the tax rules around that as concerns an individual. There are different rules that apply to corporations, but I'm going to focus on an individual. So the first slide, Canada has a residency-based tax system like most countries in the world. And as Rahul mentioned, with trusts, it's based on factual residency, which is a common law test, and it really depends on facts and circumstances and the individual's intention. We also do have some deemed residency rules. If an individual sojourns for 183 days or more in Canada, they are deemed to be resident in Canada. And Justine talked quite a bit about treaties. There can be tiebreaker tests under tax treaties that would apply in circumstances where an individual might appear to be resident in both countries. And Canada has signed treaties with more than 90 countries. So on the question of the factual residency test, it is common law based. If you wanted to do a shortcut analysis, you could look at the form NR 73, which you can look up. It's available online. It's a CRA form. It looks at big picture and more obvious ties, like where you have a home, where your family is, and also some more granular ties, such as where you have a driver's license and health insurance. So moving on to the next slide, departure from Canada. So when an individual leaves the Canadian tax net, departs for tax purposes, they are deemed to have disposed of all their assets for fair market value. It's similar to the tax rules that apply to an individual who dies in Canada. So a sale for fair market value of all your property and assets. From a fiscal policy perspective, this perhaps makes sense because once that individual is outside of Canada, it's harder for tax authorities to collect from them. And that individual will have to pay departure tax, so-called departure tax, on that deemed disposition. It's generally a capital gains tax, but in some circumstances, it can be result in income inclusion. So as of 2024, there are potential implications for alternative minimum tax. The AMT is increased to 20.5%. So where an individual realizes a large capital gain on departure from Canada, there are certain credits and deductions available that can be reduced under the AMT calculation, and there may be an AMT consequence for that departure. Normally, that can be offset against taxable income 7 years going forward, but if an individual is no longer taxable in Canada, that may be lost. So there are certain exemptions to the departure tax. Those are codified in the Income Tax Act. A big one is real property in Canada and similar resource properties. It does not apply, though, where the real property is held through a corporation, for example. There are also excluded rights or interests, which are also codified. Common ones are RRSPs and certain pension plans. and certain insurance policies. So moving on to the next slide. Those who are familiar with the Canadian tax rules might assume that there's an exemption from departure tax for taxable Canadian property, or TCP, but that is not the case, with the exception of real property and resource properties. The rest of the slide is really taken from the definition of taxable Canadian property under the Income Tax Act, and I'm going to mention something about taxable Canadian property in a minute when it comes to planning. So, an individual who's departing may have liquidity issues where, for example, they have assets with a large accrued but unrealized gain that they don't want to sell just because they're emigrating from Canada. There can be very valid reasons for that. So because of that reality, there is a mechanism under the Income Tax Act to elect to post security in lieu of paying departure tax, which would otherwise be owing on the balance due date, generally April 30th of the following year. So this must be negotiated with the Canada Revenue Agency. It's done out of a particular office, their migration office in Penticton, which is under the CRA's collections program. And the individual will have to enter into a security agreement. The terms of that agreement are generally fixed, but potentially negotiable with the Department of Justice. But you can expect that the security that the CRA will require will be at least equivalent to what a commercial lender will require. And it's determined on a case-by-case basis. So moving on, these here in terms of mechanics, there are forms that have to be filed in advance of April 30th. This can create kind of a conundrum for the individual who's electing to post security instead of paying departure tax, because the tax prep software is generally not available until early in the year. And those forms will need to be filed, but the negotiation of the security can take months, several months, a year, or even longer in our experience. So the individual may have a situation where they've elected to post security and have not paid tax owing on the balance due date, but the form of security has not been agreed to fully with the CRA yet, and there's some uncertainty as to what will be required. So that's just a practical matter in terms of planning. It sometimes sounds good in theory, but in practice, there can be some complexity. And moving on. So in terms of tax planning, I will reiterate what Rahul said. It really depends, and it's important to get that advice in advance, but it is much like a sale of those assets, similar planning. So for example, if the individual owns shares of a corporation that are qualified small business corporation shares, it's possible to claim the lifetime capital gains exemption. It's possible to use any tax attributes that are in the corporation to reduce departure tax, such as capital dividends. Their treatment will be different outside of Canada and the destination country because those are only available for Canadian-controlled private corporations. TFSAs, it's well advised to recognize gains before departing. And of course, there are no contributions to a TFSA after departure from Canada. And there can be certain elections available on departure, depending on the destination country and whether Canada has a treaty with that country. Then, here's where I pick up again on taxable Canadian property. There can be some quite favorable planning that's available where an individual has elected to defer departure tax, and they receive dividends after departure from Canada, they're subject to withholding. As Justine mentioned, the default withholding rate is 25%, but it can be reduced under a treaty. So on the eventual sale of that property, those shares, those two amounts, the departure tax for which security has been posted and the Part 13 withholding taxes are netted against each other. So the individual pays the difference between the two. That's very favorable planning and can be better depending on the circumstances than the tax planning that might be available on the sale of that same property. And again, depending on the destination country and whether Canada has a treaty with that country, it may be possible to elect to bump up, do an arrival basis bump of that property so that only the gains that accrue in that destination country after immigration to that country are recognized in that country on eventual sale of that property. Now, in all cases, as both Rahul and Justine have mentioned, it's very important to get that advance advice. In this case, you should get advice both from a Canadian tax advisor and a tax advisor in the destination country, or if it's the U.S., maybe even the state, to choose that departure date and have a very clear severing of ties from Canada, as many ties as possible, back to that NR 73 form, which is just sort of a cheat sheet proxy for what those ties are, and to establish ties in that new destination country. Also, Justine mentioned estate planning. It's important to update wills to the extent that that individual is retaining any Canadian assets that will be subject to probate in Canada, and to get wills in the country where they are moving. Just if for no other reason than to simplify probate in both places, which can otherwise be quite complex and quite expensive. So I will end it there, and Rahul will take over again and address questions.
Thanks, Lori. We have received a lot of questions, and I just want to thank everyone for their questions. The questions are all excellent, and they show, for one thing, a lot of engagement with this specific area of tax on the cross-border side. And they also show that there's not only a lot of interest in the area, but suggest that there's a lot of ongoing work that the attendees are dealing with, or ongoing issues or issues that pop up from time to time that they're facing. And so what I will say is this: we cannot, unfortunately, answer every question that's been posted, but many of the questions have frankly could be presentations of their own, or lead to presentations of their own. And so, especially in areas like life insurance and whatnot, in a cross-border context, we're going to take those back, and we're going to see if we can't do another type of presentation in the near future that deals with and answers some of those questions, because unfortunately, time doesn't permit us to do that right now. There are some questions, though, that come straight off this presentation, which are important or are relevant immediately, and that lend themselves to a quicker answer. There's a question that's come in regarding withholding tax, for example, as between two Canadian corporations. And we just want to ensure that that concept is understood. So I'm going to pass it over to Justine to answer and respond to that.
Yes. So the question is any withholding tax applied if the dividend payment is passed from an entity in Canada to its holding company in Canada for investment purposes in Canada only? The question is no. So withholding tax would apply if, for example, there's a Canadian corporation company owning a foreign corporation. There would be withholding tax on dividends, the withholding tax we're talking about, on dividends from the foreign corporation paying a dividend to a Canadian parent. There is no withholding tax between two Canadian private entities, there usually, in fact, no tax. There could be Part 4 tax, but in a pure Canadian context, as long as dividends, and I'm not talking about 55.2 here, but generally there's no tax between dividends paid from two Canadian companies, between two Canadian companies. So just to be clear on that point.
Thanks so much, Justine. If I could throw it over to Lori, there was a question that had come in as well. And this is a common type question about what can you really retain after emigrating from Canada in terms of Canadian assets and ties to Canada, and specifically whether you can retain the ownership of Canadian real estate.
Yeah, that's a very good question. It's a common question because, of course, Canadian real estate is exempt from departure tax. However, it may be a residential tie. So clients will often ask whether they can keep a condo here, for example, because they've got family that they want to visit regularly. So you could keep that condo. However, that will be a residential tie. And I have seen cases in audit where the individual did that, the taxpayer did that, and the CRA auditor and appeals officer determines that that is a residential tie to Canada, and along with other ties that the individual would tie break to residency in Canada. So it really just depends on what the other ties are.
Thanks so much, Lori. There are a few questions that have come in regarding granny trusts, and specifically whether a granny trust would have CRS requirements, and whether there would be reporting in Canada on capital distribution. So just to answer that very quickly, the granny trust has to is still administered in its jurisdiction of residence and administration, as well as where its governing law is situated. So in that jurisdiction, being the jurisdiction of its management and administration, if that jurisdiction is a signatory to this common reporting standard, then generally speaking, yes, there would be CRS reporting obligation in that jurisdiction in respect of that trust. And is there a possibility of that information coming into Canada or whatnot? The answer is potentially yes. And this is why I always underscore again, and I emphasize, you need to get your ducks in a row in these kinds of planned structures. So you need to ensure that the reporting, the compliance, everything is proper. Another, and so the flip side of that question was, okay, if a capital distribution now comes into Canada, is there tax payable on that capital distribution in Canada? Well, it's capital, then no. Is there reporting? Yes. The beneficiary resident in Canada will need to make a filing in Form T1142 to report the capital for the year in which it was received by that beneficiary. Now, fairly simple form, as I had said, you check capital, but you need to make sure in checking capital that it actually is capital for Canadian tax purposes, and that's where the devil has to be in the details. So that can be something that is something to be looked into. There is a question that has come in regarding taxable Canadian property. And I know, Laura, you talked about taxable Canadian property. Is there a deemed disposition upon death and subject to Canadian taxes for a non-resident owner of TCP?
Yes, that's a simple one. The answer is yes. And we're close to the end of our time as well. So I think we need to wrap it up there. We do appreciate the time that you have taken to spend with us. If you're able to fill out our survey, we would be grateful. And of course, if you're collecting CPD credits, they're there.
Thanks so much, everyone. You have our contact details. The Fasken website makes us easy to reach in case there are any specific questions or you'd like more information, or if there's a live client matter for example, that we might be able to help with, we're always delighted to do so. Thank you guys so much for participating and for being part of this presentation today.